Welcome to The Deep Dive. We're the podcast where we take a whole stack of sources, pull out the key insights, and, well, hopefully give you some surprising facts and perspectives.
That's the plan.
Today, we're tackling something that honestly felt impossible when it happened: the collapse of Lehman Brothers, September 15th, 2008.
It wasn't just another news story. It really kicked off the worst global financial panic since, World War II?
Yeah, exactly. And the scale. I mean, a 160-year-old company.
The fourth largest investment bank in the U.S. at the time. We're talking $639 billion in assets and $619 billion in liabilities. Just gone.
It's staggering. The largest bankruptcy in American history by far. Its effects are, well, they're still shaping things today, aren't they?
Absolutely. You can draw a line from that event to so much of our current financial landscape.
Which is why we really wanted to dig into this. For this deep dive, we've got quite a mix of sources. There's an academic paper from an international conference in 2013.
Right. Advances in social science, humanities, and management.
A really detailed study from the Swiss Management Center University, those crucial Financial Crisis Inquiry Commission reports.
Can't forget those. Plus, articles from places like The Guardian and Knowledge at Wharton.
And, of course, the official financial statements themselves, the raw numbers.
Yeah.
So our mission here is to sort of untangle this really complex, not the internal decisions, the outside pressures, the systemic weaknesses.
It all came together to bring Lehman down.
Exactly. And then look at the fallout, immediate and long term, and figure out what lessons were learned, if they were learned.
That's the big question, isn't it? Were they truly heeded?
So hopefully you'll come away from this with a much better sense of not just the what, but the why it matters. Okay, let's get into it.
Let's do it.
So to really understand how a giant like Lehman could just crumble, we kind of have to start with their core philosophy, their financial goal.
Right. And, ironically, it seems that very goal might have planted the seeds for the disaster.
In the U.S., especially for big public companies like Lehman, the dominant idea was maximizing shareholder wealth.
Shareholder value.
It was seen as, more sophisticated than just maximizing profit. It considered risk, the time value of money, shareholders' capital costs.
And it boiled down to something easily measured: the stock price. Seems logical on the surface.
It does. But here's where our sources drop a bombshell. This goal, this focus, it became a major internal cause of the bankruptcy.
Yeah, that academic paper we looked at, it argues that paying too much attention to the stock price actually sped up the collapse.
How so?
Get this. For 7 years, starting back in 2000, Lehman apparently used, no wait for it, 92% of its after-tax profits just to buy back its own stock.
92%? How is that even sustainable? That's, wow.
Exactly. It wasn't sustainable. Sure, it artificially inflated the stock price, kept up this superficial prosperity, as one source calls it.
But at what cost?
Well, it drained their cash massively. It just hammered their ability to handle any kind of shock or risk. It was like they were starving the company itself just to make the stock number look good.
So a goal that sounds rational shareholder wealth pushed to an extreme becomes destructive.
Precisely. It's a really sobering point about single-minded focus in business.
Okay, so that's one huge internal factor. But beyond that obsession with the stock price, the actual stuff on Lehman's books was problematic.
Oh, definitely. They went really heavy into mortgage-backed securities in the 2000s.
Yeah.
Bought up 5 mortgage lenders.
And even the CEO, Dick Fuld, admitted later they had too many illiquid assets, like commercial property, and not enough capital.
Yeah, the Financial Crisis Inquiry Commission found their $54 billion in real estate assets were probably way overvalued. Some bankers thought maybe half that value.
Which, if true, would have just instantly erased their equity, their entire buffer.
Exactly, and add to that illiquidity. Crazy amounts of leverage.
Explain leverage quickly for us.
Sure. It's basically using borrowed money to amplify potential returns. But it also amplifies losses. Lehman's leverage ratio went from 24-1 in 2003 up to 31-1 in 2007. $31 of debt for every $1 of equity.
That sounds incredibly risky.
It is. And they relied heavily on short-term funding. Billions in commercial paper, basically IOUs, and almost $200 billion in repos by early 2008.
Repos? Those are like short-term pawn shop loans for banks, right? Sell securities, promise to buy them back slightly higher.
That's a decent analogy, yeah. The point is, this funding was incredibly flighty if lenders got nervous.
Proof. The money disappears overnight.
Exactly. Which made them super vulnerable to shifts in confidence.
And speaking of confidence, it seems Lehman wasn't just hoping for it. They were actively trying to, manufacture it.
Ah, you're talking about Repo 105.
That's the one. Anton Valukas' big bankruptcy report flagged this, described it as clearly a dodge, window dressing.
It was an accounting trick. They'd use these Repo 105 deals to temporarily move assets off their balance sheet right when they had to report their financials.
So it made them look less leveraged, less risky than they actually were.
Precisely. They got a UK law firm to say it was technically legal under British accounting rules, but the Valukas report was clear. It was clearly intended to deceive.
Wow. A Wharton accounting professor compared it to Enron. Said Lehman's moves were more extreme than anything he'd seen since then.
Yeah, exploiting a loophole to paint a completely false picture, maintaining that superficial prosperity.
Which brings up the auditors, right? Ernst & Young, weren't they supposed to catch this?
Well, the criticism was harsh. Another Wharton professor, this time finance, Richard Herring, basically said their main job seemed to be helping Lehman misrepresent its position.
Ouch, so much for the post-Enron reform.
He definitely raised that question. Who watches the watchers? Who guards the guardians, if the auditors are complicit even passively?
The whole system breaks down. Okay, so the foundations are rotten. What about the leadership? Dick Fuld, the CEO.
Well, initially, he was very defiant, blamed rumors, market forces, the government refusing a bailout.
The blame game.
Pretty much.
Yep.
But he did eventually concede mistakes, admitted to the illiquid assets, not enough capital.
And they did try some last-minute moves, right? Trying to de-risk, sell off assets, raise some capital.
Yeah, they shed some investments, raised about $3.8 billion in equity. There was also a management shuffle. Bart McDade became the balance sheet czar. Fuld's longtime number 2, Joe Gregory, was out Aaron Callan, too.
But just too little, too late.
Seems that way. And looking at the board of directors raises more questions.
How so?
Reports suggest many board members just didn't have deep, current financial services backgrounds. Some experience was pretty dated.
Not ideal for overseeing a complex global bank.
Especially one with something like 3,000 different legal entities. For a board of 10 people, oversight must have been incredibly difficult.
Yeah, you really have to wonder if they truly grasped the scale of the risks being taken.
It's a fair question. Did they have the expertise to challenge management effectively?
And then comes the climax, the government decision. No bailout for Lehman.
Right. Which was a shocker because they had stepped in for Bear Stearns just months before, and later for AIG, Fannie Mae.
So why not Lehman? The official reason was
Legal constraints and wanting to avoid moral hazard, basically.
Yeah.
Not wanting to encourage risky behavior by guaranteeing bailouts. Treasury Secretary Hank Paulson reportedly told Fuld point blank, no rescue was coming.
But Fuld insisted they were solvent, had billions in equity.
He did, but the Fed chair, Ben Bernanke, disagreed. He said publicly he thought Lehman had a capital hole that was just way too big to fill.
So a massive disagreement about their actual financial health right at the critical moment.
Yeah, and it ignited this huge debate. Was letting Lehman fail necessary discipline for the market even if it hurt?
Or was it, as others called it, a calamity catastrophe that made everything exponentially worse?
There's still disagreement on that. Some critics later said the government waited too long, should have forced Lehman to fix its problems much earlier, instead of letting it reach that cliff edge.
Okay, so Lehman goes down. What happens next? The ripple effect.
It was immediate and devastating. It poured gasoline on the fire of the existing financial crisis.
Which was already bubbling because of the subprime mortgage mess, right? Bad loans packaged up.
Exactly. Lax lending, loose regulation, banks bundling risky mortgages into complex securities, CDOs, MBS.
Creating this incredibly tangled web of interconnected risk, as one source put it.
Lehman's failure just shattered confidence. Credit markets froze. Banks stopped lending to each other. Liquidity just vanished.
And the economic cost.
Estimated around $10 trillion in lost global economic output. Trillion with a T.
Just staggering. Now, you mentioned credit default swaps, CDSs. They got a lot of blame, too.
They did. But our sources suggest it's a bit more nuanced. CDSs are basically insurance policies on debt. The market was huge, opaque, concentrated. That could be a systemic risk.
But they weren't the root cause.
Not the primary cause, no. They were tools, used for hedging risk, but also for speculation. The real issue was the sheer scale of bad debt they were written on, and how interconnected everything was. Lack of transparency was key.
And the human costs. We talk about billions, but...
Yeah, around 25,000 Lehman employees lost their jobs. Just like that, careers gone.
And the investors, creditors.
Well, secured creditors eventually got paid back in full.
Yeah.
But the unsecured ones, They waited 14 years through the bankruptcy process
14 years.
and ended up getting about 41 cents on the dollar, finally settled in September 2022. A long, painful wait.
So the inevitable response, regulation, Dodd-Frank.
Yep, the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, a massive piece of legislation.
What were the main goals?
Primarily, stricter oversight.
Yeah.
Trying to prevent another meltdown, it targeted leverage, risk management, accounting.
And created some new agencies.
Right. The Financial Stability Oversight Council, FSOC, to watch for systemic risks across the whole system, and the Consumer Financial Protection Bureau, CFPB, to look out for consumers.
What about specific bank activities?
That's where the Volcker Rule comes in. It largely stopped banks from making speculative bets with their own money proprietary trading.
Okay. And the too big to fail problem.
Dodd-Frank introduced an orderly liquidation authority. Basically, a way for the government to wind down a huge failing financial firm in a controlled way, avoiding a chaotic bankruptcy like Lehman's. Sort of like how they handle failing banks.
What else? Anything about those risky mortgage bundles?
Yeah, rules requiring securitizers, the ones packaging the loans to keep some skin in the game, hold on to a portion of the risk themselves.
The idea being they'll be more careful about the quality of the loans if they also stand to lose money.
Exactly. Better underwriting standards, hopefully. Plus, more SEC oversight of credit rating agencies, the ones who gave AAA ratings to junk, and new rules on executive compensation, trying to stop bonuses that encourage excessive risk-taking.
Quite a response. So bringing it all together,
Yeah.
What's the big takeaway for someone listening today?
I think the Lehman story is just such a stark reminder of how internal company choices, especially something as fundamental as its main financial goal.
Like that shareholder wealth maximization thing.
Right, how that interacts with complex finance, with regulations or lack thereof, to create risks that don't just stay inside the company, they can spill out and affect everyone. Systemic risk.
So thinking about all that, it leaves us with a big question, doesn't it? Should a financial institution ever just focus on one single metric, like boosting the stock price, above everything else?
Or does genuine long-term health always need, a broader view? Balancing shareholders with other stakeholders, having rock-solid risk controls, and just being fundamentally transparent about what's going on.
It really makes you think about the incentives and pressures within these huge institutions and how those choices play out in the economy we all live in, even now. Something to definitely mull over.